Have you ever thought about diversifying your investment portfolio? In the world of finance, diversification is a buzzword that's been thrown around quite a bit, but what does it really mean? Well, imagine you're at a buffet. If you only pile your plate with mashed potatoes, you might miss out on the roast beef or the chocolate cake. Diversification is essentially the same idea, but instead of food, we're talking about your investments. Now, there are two main types of investments we can consider: traditional and alternative. Traditional investments are your basic bread and butter of the financial world. Think stocks, bonds, cash, and real estate. They've been around for a long time and they're generally well regulated and relatively predictable, but then there are alternative investments. These are the more exotic offerings on the financial buffet. We're talking about venture capital, peer-to-peer lending, and precious metals, among others. These are not your typical investments, and they're gaining popularity as people seek ways to diversify their portfolios beyond the traditional options. Venture capital, for instance, involves investing in startups or small companies with the potential for significant growth. Peer-to-peer lending allows you to act as a bank, lending your money directly to individuals or businesses in return for interest payments. And precious metals like gold or silver are tangible assets that can act as a hedge against inflation or economic instability. But here's the question: are these alternative investments a smart move or a risky gambit? Well, that depends on a number of factors, including your financial goals, your tolerance for risk, and your understanding of the investment itself. Like the buffet, it's all about balance. You don't want to load up on just one thing. A diversified portfolio can help spread the risk and potentially increase your returns. But it's important to understand what you're investing in and why. So, are you ready to explore the world of alternative investments? Are you interested in diversifying your financial buffet? And most importantly, are you ready to potentially grow your wealth in new and exciting ways? Are these alternative investments a smart move or a risky gambit? Stick around to find out. Scene script. First, what exactly are traditional investments? Well, when we talk about traditional investments, we're generally referring to the big three: stocks, bonds, and cash. These are the tried and true vehicles that have been used to grow wealth for centuries. Stocks, or shares in a company, represent ownership in that firm. When you buy a stock, you're essentially buying a small slice of that company, betting that its value will go up over time. Stocks are considered higher risk because their value can fluctuate dramatically, but they also have the potential for significant returns. Bonds, on the other hand, are essentially loans that you give to a corporation or government entity. In return, you receive a promise that your loan will be repaid with interest over a specific period. Bonds are generally considered lower risk than stocks because they offer a fixed return, but the trade-off is that their potential for high returns is more limited. And then there's cash. Cash investments include savings accounts and certificates of deposit. They're the safest of the three, but they also have the lowest potential for return. Now, the merits of these traditional investments are numerous. They're relatively easy to understand, they're widely accessible, and there's a wealth of historical data that can help you make informed decisions. Plus, they're highly liquid, meaning you can quickly and easily convert them into cash when necessary. But of course, there are risks involved. The value of stocks and bonds can fluctuate due to economic factors, market trends, and company-specific events. And while cash is the safest option, it's also susceptible to inflation, which erodes its purchasing power over time. So yes, traditional investments come with their own set of pros and cons. But they've stood the test of time for a reason. They offer a balance of risk and return that has proven effective for many investors. Now that we understand traditional investments, let's dive into the world of alternative investments. So, what sets alternative investments apart from traditional ones? Let's dive right in. Alternative investments are a type of investment that don't fit into the conventional investment categories like stocks, bonds, or cash. They're often used by investors to diversify their portfolio and potentially enhance returns. One of the key differences between alternative and traditional investments is in their inherent nature. While traditional investments usually involve buying a tangible asset, alternative investments often involve a degree of speculation. For example, you might invest in a startup company, not because you want to own a part of it, but because you believe in its potential to grow. Now let's look at some examples of alternative investments. First up, we have peer-to-peer lending. This is a method of debt financing where individuals can lend and borrow money without the need for a traditional financial institution as an intermediary. It's like playing the bank, but with potentially higher returns and, of course, higher risks. Next, we have venture capital. This is a type of private equity. and a form of financing that is provided by firms or funds to small, early-stage emerging firms that are deemed to have high growth potential. It's like betting on the next big thing, but remember, not every startup becomes a unicorn. Last but not least, we have precious metals like gold, silver, and platinum. These are often seen as a safe haven during times of financial uncertainty. They may not offer the same potential for high returns as other alternative investments, but they can add a layer of stability to your portfolio. But remember, with great potential comes great risks. Alternative investments are typically less regulated than traditional investments and can be more volatile. They also often require a larger initial investment and may be harder to sell quickly if you need to cash out. So there you have it. We've seen how alternative investments can offer diversification, but are they right for everyone? It really depends on your individual financial goals, your risk tolerance, and your investment horizon. As always, do your due diligence before you dive in. Now that we've covered the basics, it's time to compare and contrast. When we look at traditional and alternative investments side by side, it's like comparing apples to oranges. They're both fruits, yes, but they each bring a unique flavor to the table. Likewise, traditional and alternative investments each have their own set of advantages and potential drawbacks. Let's start with traditional investments. Stocks, bonds, and mutual funds are the go-to for many investors. They offer a sense of familiarity and can provide a steady stream of income over time. However, they're also linked to the ebbs and flows of the market, which can lead to volatility. Now let's shift gears to alternative investments. These assets, which include things like peer-to-peer lending, venture capital, and precious metals, provide a way to diversify your portfolio beyond the traditional markets. This can be particularly appealing to those looking for a hedge against market volatility. However, these investments can also carry more risk and may require a larger initial investment. So, who might be more inclined to each type of investment? Traditional investments often appeal to those looking for a more predictable long-term strategy. These investors might be saving for retirement or a child's college fund and value the relative stability these investments can provide. On the other hand, alternative investments might attract those willing to take on a bit more risk for the potential of higher returns. These investors might have a larger amount of disposable income and are willing to venture into less charted territory. But it's not an either-or situation. Many savvy investors incorporate both traditional and alternative investments into their portfolios. This approach, known as diversification, can help spread risk and potentially increase overall returns. As we've seen, both traditional and alternative investments have their place in a diversified portfolio. The key is to understand your financial goals, risk tolerance, and investment timeline to determine the best mix for you. And remember, investing is not a one-size-fits-all endeavor. It's a journey that should be tailored to your unique needs and objectives. So, should you consider alternative investments to diversify your portfolio? A question that we've tackled today, and as we've seen, the answer is not a simple yes or no, but a more nuanced, it depends. Let's summarize what we've learned. Traditional investments like stocks, bonds, and mutual funds have been the mainstay of most portfolios for decades, and for good reason. They offer a balance of risk and reward, are easily accessible, and provide the opportunity for steady growth over time. On the other hand, alternative investments, including peer-to-peer lending, venture capital, and precious metals, present an exciting frontier for diversification. These options can offer higher returns and access to markets that are less correlated with the traditional financial markets, reducing overall portfolio risk. However, they also come with their own set of challenges. These might include a higher level of risk, less liquidity, and a requirement for more specialized knowledge. Therefore, they should be approached with caution and a clear understanding of their intricacies. The main takeaway here is the importance of diversification in building wealth. A well-balanced portfolio that includes both traditional and alternative investments can help you weather market volatility, mitigate risk, and pursue growth opportunities from different angles. It's about not putting all your eggs in one basket, but spreading them across multiple baskets, each with its own potential for return and risk profile. Remember, the key to successful investing lies in understanding your options and making informed decisions. The world of investing is rich and varied, offering numerous paths to wealth. It's up to you to explore, understand, and choose wisely. So, to return to our initial question, should you consider alternative investments to diversify your portfolio? The answer is a resounding, explore your options, understand the risks, and make informed decisions. Remember, the key to successful investing lies in understanding your options and making informed decisions. Want to keep learning about wealth-building strategies? Immerse yourself in the world of finance and investment by subscribing. Discover the power of diversification through alternative and traditional investments. Subscribe now and join us on this journey to financial success.